Understanding implied volatility context. This is a hard one, so get your helmet on. A lot of people have a lot of questions about IVR and how come it has some huge swings and this and that. What happens after a year? All this kind of stuff. Let's take a look. You're going to need your helmet. Implied volatility. The implied volatility of an option is the standard deviation for the underlying's annual log returns that would make the current option price match the Black-Scholes model price. As option sellers, high implied volatility means both large credits are available and that we stand to profit if implied volatility reverts. Also, less outlier risk, lots of other things about implied volatility, but bigger credits mean the potential to make more money. Different underlyings have different typical implied volatility values. That can make things tricky to judge which implied volatilities qualify as high. For example, product A, let's just say, let me take something out of the blue, like BABA, has an implied volatility of 40. I'm just making up numbers. And it's an $80 stock with an implied volatility of 40. I can't think of a stock, but let's just say XYZ also has a price of $80 and it has an implied volatility of 20. How do you know if the 40 volatility of BABA is actually richer than the 20 volatility of XYZ, even though they're both $80 stocks? Well, that's what we use IVR for. IVR gives us context around the implied volatility levels, so we know what is actually high.
It is almost like beta weighting volatility.
Yeah, sure.
Okay.
So to help traders use a wide variety of underlyings, we often consider the implied volatility rank. So we're just talking about. We put the formula here. And remember, intraday implied volatility, we don't put any fences around. It could be go up to 120 like Dell was the other day and go down to, it could go down to below zero. Overnight, we cap everything at 100. So 100 is the max on the upside, 0 is the max on the low side. The definition makes IVR sensitive to the current implied volatility, but it can also change how IVR needs to be interpreting when the standing highs and lows fall over a 1-year time horizon. Because we found through our research that 1 year is the perfect time horizon. We used to let customers determine the duration, the time horizon. This is something that we came up with years ago when we built thinkorswim, and we've popularized it. It's now become an industry standard. TP was the one that really did most of the legwork and most of the modeling around IVR. This never existed on any platform anywhere until we built it, put it in on Toss, and revamped it and really built up the logic around this on Tasty. It's a whole different animal. On Toss, they're still using stuff we wrote 25 years ago. On Tasty, we have constantly updated this so that our model is, you can't have a better model. And we don't let you mess with the durations so that everybody has the same kind of numbers. This is the SPY annual implied volatility, the max and the minimum. This is from 2018 to 2024. So you can see some big jumps. You see the huge spike when the pandemic broke, we got up to about 80. And in the last 2 years, we haven't really had much of spike. In 2021, we had the meme stock. In 2022, we had a sell-off in the market, so volatility got up, into the 30s. But for the last 2 years, we haven't got much past the mid-20s. And now we're down, you can see it, we're on the low end of the range. So we have the annual max IV, the IV itself, and then the annual minimum IV. You can kind of see the faint lines behind the yellow lines. This causes how implied volatility translates to IVR change over time. So what we did on this slide was we gave you a plot of implied volatility. This is the IVR over time for different levels of implied volatility values. We did this for over multiple years, from 2018 up to 2024. So you can kind of see, my biggest takeaway from this is in periods of extreme low implied volatility, you can end up with extremely high IVR. Yeah, you can see right now.
Peaks and valleys are going to correspond.
Yeah, if you look at 2023 and 2024, which is the right-hand side of this chart, you can see that implied volatility is super low right now. But if you go to the next chart, you can see that the IV rank in the last 2 years has jumped up to even close to 100 in some cases because of how low the implied volatility has been for the last year. And this gives you a lot more of a visual of how implied volatility rank works. It's not always high when implied volatility is high. It can be super high when implied volatility is low because it gets there much faster. Because high volatility is often market wide, which it is, this can be relatively consistent between underlyings. So this is the last slide we showed was SPY. This is the Russell 2000 IWM. And you can see it almost looks like the SPY. So that's why there's not a lot of, if you don't have any kind of product diversification, you're going to end up with positions that have very similar volatility characteristics. Like this slide here, if you go back one slide, Beth, and this slide here, which is the SPY, look almost identical. You couldn't tell them apart, even though they're two very different indices. Right. And they've moved very different directionally. The Russells underperformed the S&Ps, the SPY by a lot over the last couple of years. And yet the IVR plots look exactly the same. We then move to an individual stock, which has been under a lot more pressure. And a stock like Tesla, this is Tesla. A stock like Tesla doesn't have, when it's not going higher, it doesn't have all this upside pricing skew. Like if you looked at this plot of IVR, you'd be like, hey, we should be trading Tesla because it hasn't really done much. Sure. I mean, from a volatility side, it doesn't have the extreme to the upside and it doesn't have the extreme to the downside. It's kind of been no man's land. And that's pretty much goes to say what's been happening in Tesla over the last 2 years. It really hasn't gone anywhere. Stocks like Tesla only have huge implied volatility when the upside explodes. And right now it doesn't have that. So this is why Tesla looks the way it is. This is what we call an atypical underlying that has its own context. And then we decided to look at GameStop. What's unique about GameStop is that recently, if you kind of look at GameStop if you look at this chart since 2021, GameStop has been, kind of trading implied volatility rank on its butt. But just recently, it had an explosion because the meme stocks popped up for a little bit. So GameStop implied volatility rank jumped up, and all of a sudden things get to heightened levels.
Interesting from a vol point of view. Sure.
Yeah, it's just news related. Implied volatility rank is a very helpful metric for evaluating if the current credits available in an underlying are higher or lower than typical. IVR is, however, sensitive to old implied volatility extremes passing beyond the 1 year time horizon. That's the weakness of this logic, is that there are 1 year time horizons, and when things clear out, things change. We have analyzed this up, down, and sideways, and this is the best way to do it. No matter what, does it have a few faults? Of course. We couldn't find a better way to do it. This was the cleanest, simplest, most straightforward way. So following extreme volatility conditions and exactly 1 year later, it's important for us to contextualize how we interpret implied volatility rank values. The current standing, 1 year minimum and max for SPY IV were reached on 11/22/23 and 10/20/23, respectively. So at least until fall, you can be confident that the high IVR means high IVR and the low IVR means low implied volatility. That's heavy, but it's really good piece. Really good.
It was a good way of explaining it.